Hi, I'm Tim from SPX Option Trader. When I tell people what I do for a living, one of the first reactions I get from people is that trading options, especially options that expire the same day, well, that's just basically gambling. Now, honestly, I understand why people think that. These contracts expire the same day, they move extremely fast, you can see very large gains or losses in just minutes. But here's the thing. Speed alone doesn't make something gambling. What matters is how the decision is made and how risk is handled. So I want to explain why the confusion exists and what the real difference actually is. Options that expire the same day, commonly called zero DTE options, look extreme compared to traditional investing. They move very fast, gains or losses can happen in literally minutes. And when someone sees that for the first time, it feels unpredictable. And when something feels unpredictable, people just naturally assume, well, it must be gambling. Here's what often happens for those trading zero DTE options. A trader sees a fast move and reacts to it. They enter the trade because it feels just obvious at the moment. Then the price moves rather quickly, and either they start to panic because it's going the wrong way, or they start hoping because it's going the way they thought. And that experience feels just like gambling, not because of the option contracts themselves, but because the trade was entered without a plan for how risk would be managed afterwards. So before we go any further, we need to define what gambling actually is. Think about a roulette wheel. Now, clearly playing roulette is gambling. And in roulette, you can choose when to bet or you can wait. You can choose red, black, a number. You can wait for 5 reds in a row and then decide that the next spin is going to be black. But no matter what strategy you use, it's still gambling. And here's why. Once the bet is placed, your decision is over. You can't exit early. You can't reduce your risk. You can't respond to what's happening as the wheel turns. You just wait for the final result. Now, certainly you choose when to bet, but once the bet is placed, you're locked in and you simply wait for the result. So here's the key idea. In gambling, once the bet is placed, you're finished. Your decision is over. You wait for the final outcome and you are unable to respond to it. But trading is structured differently. Now, in trading, you clearly don't control the market any more than you control a roulette wheel. A single trader can't make price go up or down. But a trading decision doesn't end when the trade begins. After a trade is entered, a trader can respond to what the market is doing. They can reduce exposure, they can exit early, they can decide conditions are no longer acceptable, and they can exit the trade. And that's exactly what makes it different from gambling. Think about a horse race. Once the gate opens, the decision is over. You just wait for the finish. But a trade isn't like that at all. You're not waiting for a final outcome. You're managing exposure while the situation is unfolding. A bet is decided once. A trade is managed over time. And where traders run into trouble is when they stop doing that. So what usually causes the damage isn't the trade idea itself. It's what happens after the trade starts. A fast move can create urgency and it feels like something important is happening right now. So traders chase the move because they feel they're missing it. Or they stay in a trade that they should have exited because they're just hoping against hope that the price will come back. Now, those aren't planned decisions. At that point, the person isn't managing risk anymore. They're just waiting for an outcome. And when a trade becomes put the money in and hope, then it starts to resemble gambling. But you see, the problem isn't the market. The problem is treating a trade like a bet. Trading zero DTE options is a high-risk activity. It moves fast. There are losing trades. But risk alone doesn't make something gambling. If money is committed and you're locked into the outcome, well, then that's a wager. But if money is committed and you can still respond, adjust, or step aside, That's a managed decision. Now, certainly, trading can be treated like gambling if someone places a trade and just waits for the results. But when the trade is being managed while the market unfolds, then trading is a risk management process. It's not a bet. Here's a typical intraday move. Right? Early in the session, the price moves strongly in one direction and it feels obvious. And that's when traders feel they have to act immediately. Now, sometimes the move continues, sometimes it reverses. The important part is this: the trader is not locked into a single outcome once the trade begins. A bet is a completed decision. A trade is an ongoing decision. Now, uncertainty exists in both, right? The difference is this: in gambling, once you act, you're finished. In trading, once you act, the decision process continues. You're not choosing an outcome. You are managing risk while information develops. So yes, trading 0 DTE options is risky. But risk and gambling are not the same thing. What matters is whether you're locked into the outcome or you're able to respond to it. And that's really the difference. If you want a deeper explanation of how I approach trading every day, I've written detailed guides on spxoptiontrader.com.